The difference between a forward contract and a futures contract. Definition of forward contract. A forward contract is a customized agreement between two parties to buy or sell an asset at a specified price, the forward price, on a future date, the maturity date. It is a private transaction negotiated directly between the buyer and seller without standardized terms or regulations. Customization and flexibility. Forward contracts offer flexibility in terms of contract size, expiration date, and specific terms tailored to the needs of the parties involved. They are commonly used in over-the-counter (OTC) markets for hedging, speculation, or managing future price risks. Counterparty risk. Forward contracts carry counterparty risk, as they are privately negotiated agreements. There is a risk that one party may default on their obligations, potentially leading to financial losses or contract renegotiations. Settlement. Settlement of a forward contract occurs on the maturity date when the buyer pays the agreed-upon price and takes delivery of the asset, and the seller delivers the asset and receives payment. There is no standardization in how settlement occurs, which depends on the terms agreed upon at the outset. Regulation and oversight. Forward contracts are typically unregulated and do not trade on exchanges. They are governed by the terms negotiated between the parties, with minimal external oversight or reporting requirements. Definition of futures contract. A futures contract is a standardized agreement to buy or sell a specified quantity of an underlying asset at a predetermined price, the futures price, on a specified future date, the expiration date. Futures contracts are traded on organized exchanges such as the Chicago Mercantile Exchange, CME. Standardization and clearinghouse. Futures contracts are highly standardized in terms of contract size, expiration date, and quality of the underlying asset. They are cleared through a central clearinghouse, which acts as an intermediary to guarantee performance and reduce counterparty risk. Liquidity and transparency. Futures contracts offer high liquidity and transparency due to their exchange-traded nature. They are publicly traded, with prices and trading volumes readily available to market participants, facilitating price discovery and efficient market operations. Margin requirements. Futures contracts require participants to deposit margin, a performance bond, with the clearinghouse to cover potential losses. Margin requirements ensure financial integrity and mitigate risk, allowing traders to leverage their positions in the futures market. Settlement. Settlement of a futures contract can occur through physical delivery of the underlying asset, for commodities, or cash settlement based on the difference between the futures price and the spot price at expiration. Most futures contracts are closed out before expiration through offsetting trades. Understanding the differences between forward contracts and futures contracts helps market participants and investors choose the appropriate hedging or speculative tools based on their risk management strategies, liquidity needs, and regulatory considerations.